Hi there, it's Bill with Smart Trades, and it's August 31st, Tuesday around 12:30 Pacific time. That's about a half an hour before the stock market closes, and wanted to do a look at breadth ratios in the current market and compare that to some historic declines of the past, and perhaps get some clues on what's in store for us in the days and perhaps weeks ahead. And first up on tap here, this is the Dow Jones Industrial Average. As you can see, it's a daily chart, and I've superimposed here the very popular, very bearish Elliott wave count. That's basically saying that we're about ready to descend into the abyss in a series of third waves. That said, I don't necessarily favor that count. I certainly see it as a possibility and would be very defensive if it started to unfold, and obviously look to get short if indeed it starts to unfold. But I don't think it's ready to keel over just yet. Moreover, I think there's a possibility it's not going to keel over at all. First off, let's look back at the recent peak, the late April peak, and I'll bring your attention to the first pulse down off of that high, and that produced a new low on the breadth ratios. I measure breadth using the NYSE advancing issues, and as you can see, we produced a lower low, came back up and produced a lower high, and then obviously we went much lower, and the breadth ratios fell apart as well on that the very sharp crash into early May. The current market is a bit different. We did indeed go down pretty hard off of the first decline off of the recent peaks. However, from there, the breadth ratios have actually recovered. We've actually made a new high, and we're in the process of making a series of higher lows. What that tells me is that this market needs a little more time, perhaps, to set up for a large decline. And anyway, let's go back. I'm going to review some of, as I said, the recent history. And this indeed is 2008. And you can see as we came off the high, breadth ratios made a series, again, of lower highs and lower lows, both on the initial decline and on the secondary decline. Now, this is the 1990 peak, same basic pattern of lower peaks and lower lows on the advance decline ratio, or the advances as I show here. This is 1987. Again, you can see that channel pointing lower on the breadth ratios. We kick up not until after we've made a low back in October of 87. But on the way down, you have a series of lower peaks and lower lows, both leading into and following the top, and particularly heading into the crash. Going back even further still, this is the 73, 74 bear market, or the beginning of it anyway. And again, here's that pattern of lower lows and lower highs going into the first decline. We don't get a new series of higher peaks until after the market is starting to rally a bit and correct that bear market and that decline. Now again, here's the current market, and here's one scenario that might allow us to rally a bit and still go a lot lower. I don't necessarily favor this, but this sort of fits the bill in terms of the breadth ratios. Again, you see here the higher highs and higher lows in breadth. Perhaps we're going to go down, make one more lower low in the market, have bullish divergences, get a bit of a correction. That might allow the breadth ratios to keel over a bit and set the stage for a larger decline. Obviously I have no idea if that's going to occur or not, but it's worth having this roadmap to see if indeed we get a corrective make a new low and then have a corrective rally back up, perhaps to the 10,400 level basis the Dow. If breadth ratios were rolling over there, if we started to make new lows and lower peaks, that would be a bearish setup for perhaps a secondary and larger decline. Now here's an alternative point of view, and that is that indeed this entire corrective process is not yet over. And in this scenario, we're actually going to go back up above the August peak, and perhaps even go back and retest the April peak in what I would call a C wave of a B wave. And in other words, this entire process is still part of a much larger correction. Eventually, that's going to lead us to yet lower prices, but in the meantime, we'd see somewhat of a substantial rally again, possibly back to the April peak. Again, it's way too early to tell which of these scenarios is going to unfold, but just want to have look at both potential points of view, both the super bearish and the somewhat more short-term bullish. Here's a close-up of the Dow. This again is that 5-wave pattern, and what is interesting is that to me we've got corrective looking patterns both up and down since the 24th or so, and the possibility is that we're in a flat or maybe even a triangle. Again, the count here would be 1, 2, 3. We're still working on 4 perhaps, and that'll take us to a new low, and then a more substantial corrective rally, indicated again by the breadth ratios actually trending up a bit. Now here we have the NASDAQ 100, and this is a 30-minute chart. This is the more bullish scenario, and showing the possibility that we've already bottomed off the recent lows. I don't necessarily favor that. The market's not acting like it's done to the downside, even though breadth is improving. And so that takes us to this next scenario, which I think makes the most sense. Basically, we've got what I'm calling A down. We have an irregular B back up. We have a 5-wave sequence still in progress of wave C, and the current sideways pattern, again with corrective rallies and corrective declines, best counts as a triangle. Now that triangle is possibly done. Ideally, I'd like to see it rally back into the 1780 area basis, the NASDAQ 100 index. And here's the more bearish point of view, which allows for basically the same count, a relatively moderate new low, and then a rally back up, perhaps to the 1800 level, perhaps higher. That would be the top of the previous 4th wave, if indeed this bearish pattern is the one in force. At any rate, short term, both patterns, both the impulse to the downside, the 5-wave pattern to the downside, and the corrective ABC, basically are looking for the same short-term pattern, the possibility of a little bit of a rally back up, and then new lows. If we still see breadth holding up, likely we're going to get a bounce off of that low. But we'll take it again, as always, one step at a time. A breakout above the top of the triangle negates the pattern, in particular the highs from a couple of days back. And if we were to accelerate substantially below the recent lows, and if breadth ratios were to make new lows, I would have to reevaluate this count. But for now, this is what I prefer. This also fits nicely with the holiday season here. It allows the market basically to go nowhere until after Labor Day, which I think is not an unlikely scenario, given that the powers that be are basically out in the Hamptons or out at the U.S. Open enjoying themselves till after Labor Day. Anyway, that's about it for now. Hope you enjoyed it, and hope you're having a great week. Talk to you soon. Bye-bye.